earnings expectations are extremely elevated. We have the largest deviation for earnings expectations for 2026, from the long-term growth trend going back to 1900 ever on record. Now, that doesn't mean the markets are going to crash tomorrow. However, every time we've had these type of deviations historically, you have a reversion in earnings due to some event, recession, financial event, credit event, whatever it is. There will be some event that causes an unwinding of these expectations and earnings, and then markets have to revalue. And then that's where you get this unwinding of the market, whether it's a bubble or not, who knows? But that's where you're going to get a much deeper correction, 15, 20, 30%.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back at the end of another week for another weekly market recap with my good friend, the Fit as a Fiddle portfolio manager, Lance Roberts. Lance, how you doing?
I've always wondered about that. What does fit as a fiddle actually mean, right? Where does that come from?
Well, I'm kind of guessing it comes from Ireland because of the fiddle. So I picked it
How does a
because,
fiddle fit? That's, because like you say, that guy's fit as a fiddle. So it's great. It means he's healthy, but what does that have to do with it? I've always wondered about that. I don't know where it actually came from. I've always wondered what it actually meant
yeah,
because a fiddle can't really be fit, right?
well, maybe it's kind of got like a narrow middle, right?
Maybe.
It's not like a fat thing.
Then
Um,
I could be fit as a cello.
you could be, but then I don't know if you'd be all that fit. That'd kind of be like a backhanded compliment.
Exactly. Oh, funny story. Funny story. Um, I had to go to the doctor yesterday with my wife, and so they were doing some kind of the basic kind of test stuff. When you go in for an appointment, and so they do the weight, and they do the blood test, and they do her height. Well, for 15 years, I've been married to this woman, and she has claimed for years that she is 5'5.5",
Hmm.
mind you, 5'5.5". And the kids are all taller than her. And so she's the shortest person in the whole family. And the kids have been telling her for years, like, there is no way on hell that you are 5'5.5". And so they measured her yesterday, they measured her height, and they come back and it says, you're 165.5. And she was like, what does that mean? I go, well, that's centimeters, honey. And she goes, well, what does that mean? I'm 5'5.5", right? And I was like, no, you're like 5'4", barely.
Barely.
Barely 5'4". And so she is completely devastated now because she has sworn for years that she is 5'5.5", and she is now 5'4", and she's going through the grieving process now.
Well, tell her it happens to all of us. I know I've lost like a half inch already from my height.
Yeah.
And I thought you were going into dangerous territory. I thought you were going to start to share her weight. So good thing you
Oh
didn't.
no,
So
I'm not stupid.
yeah, exactly. Nice save on that one. But your wife, I've met her. She is definitely fit as a fiddle. Applies to her. So, anyways, I used fit as a fiddle one because I just got back from Ireland. I had a fantastic time there with my daughter. Um, Sadly, I came back without my phone and with the flu. So we're going to keep this one relatively short. Yeah, I've actually got
How
a
did
lot
you
of
come
stories
back
to
without
tell.
your phone? At what point did you realize you left your phone in Ireland?
The moment I stepped onto the plane, and then the FAA rules prevent you from getting off the plane again.
Yep.
Yeah.
Where was
So,
the where's the phone at?
well, it now is getting shipped to me. So they
Oh,
did find.
I was gonna ask you, is it somewhere like your daughter has it and she can ship it to you?
No, they actually, sitting there on the tarmac, I still had my laptop. I used Find My Phone. I found where it was in the terminal. I screenshotted the map, sent it to them. They sent someone to pick it up, and it's now being shipped to me. So,
What?
anyways, I got a lot of stories about this trip, but I'm not going to be able to share them today because I just do not have the stamina.
All
Folks,
right.
we're going to keep this one short. As
Next
you can
week.
tell from my voice, I'm probably, I'm on fumes and probably won't make it very long.
All right. Well, next week
Um,
we'll do Ireland stories.
yeah, no, and I got like three or four good rant materials coming out of it. More on the good life advice side of things, but again, we're going to have to save most of those to a future week.
Uh, Good.
All right. So Lance, I think the big question for this week is, really tried not to watch the markets, and of course, sort of like you, I hop on the plane on Friday, and the markets have their biggest move of the year, not of the year, but certainly of the past bunch of months. And it's been volatile. But last time we were talking, you were walking us through the technicals, and you kind of had your two different main theses of where the market could go, and it really all depended on whether support held at the 20-day.
Right.
What's that doing right now?
It's holding at the 20-day. Here, let me just we'll just jump right into some technicals on it right now. Just give me a second here. So this is the chart we kind of been looking at. So a couple of things. One is that there were kind of three pathways that we laid out previously. So the first one was a 50% probability market moves higher towards 6,600 by the end of this year. The second path, which was about a 35% chance, was that we get a correction lower to around 6,200, which is where the 50-day moving average is. Could go as low as 6,000 on the 200-day. But so we had those two primaries. But the third one was a 15% chance we just kind of go sideways for a couple of months. And right now, that's really starting to be the case that's playing out here. So just to step back here for a moment. On Thursday night, so we write a daily market commentary. You can, if you follow me on X, at Lance Roberts, or if you follow me on Substack at Lance Roberts, you go to our website, willinvestmengadvice.com. You can actually subscribe to it. We email it out every day before the market opens. But on Thursday, I wrote this piece saying we've had two things going on in the markets. First of all, we've had an exceptionally long stretch of the market without a plus or minus 1% move. From a historical basis, we've been running for quite a few weeks with very, very low volatility. The second thing is we'd gone through the longest stretch with the market above the 20-day moving average since 1968. And so the juxt of that article that I wrote Thursday night, which published Friday morning, last Friday morning, was basically, we're going to get some volatility here. Just be ready. And of course, Friday, the market's down 1.75%. Then on Monday, the market's up 1.5%. Then on Tuesday, we're down. On Wednesday, we're up. On Thursday, we're down. On Friday, we're talking right now, we're up. And so as you can see, the market had this correction, broke the 20-day moving average, and then has been kind of doing this very kind of stair-step rally back higher. And has now closed that breakdown gap, which is bullish. So we're above the 20-day moving average. We'll close above the 20-day moving average on Friday. And I'll tell you why that's important here in a second. And we've closed that gap. So the bullish trend is still very much there. However, just still being a little bit cautious here, that kind of shaded area in the background, that's money flows. That continued, despite this rally, money flows have actually been weakening. At the same time, you still have a momentum sell signal in place. So you've got a rising market and a declining kind of momentum sell signal. So that's called a negative divergence. It's very minor right now. Doesn't suggest anything major, but does suggest that we might just kind of continue to grind out here over the next, week or two. So we'll see. So again, this market's been very much a buy the dip rally. We saw that on Monday. We saw retail investors step in Monday morning. They bought the dip. They've been buying the dip in AI stocks all week. So it's been Palantir, and Apple has done well this week on their announcement of doing $600 million investment into building plants here in the US. In fact, Houston's going to be one of the cities they build a 225,000 square foot facility in. So great for Houston. But that's been helping Apple rally, of course, because of the size of Apple and Microsoft and Google and those stocks in the index. That's been dragging the whole index higher this week. So again, overall, the market still remains very bullish. There's nothing to be worried about here to any great degree. But the rally is fairly narrow. Breadth is not great. Money flows, as you can see on the chart, are weakening. So I do suggest that we've still got some potential kind of choppy waters ahead of us over the next month. This doesn't mean a major correction or anything like that, but the market's not likely to take off and start running into the end of the year right now, particularly as we wrap up earnings season. We're going to start focusing a lot more on the economic data, which the juxt of this weekend's newsletter that'll go out tomorrow morning. Again, if you're following me on Substack, at Lance Roberts, Twitter, wherever, I'll publish it out in the morning. But that newsletter is covering the cracks in the economic foundation. So I was digging down to a lot of the economic data, whether it's employment or ISM, manufacturing services, et cetera, clear weakening in the economy, that's going to eventually feed through to earnings. And earnings, while they beat estimates, if it had not been for financials and the mega cap stocks, the S&P would have had no earnings growth in the second quarter. So despite the fact that we had good earnings reports and we had a very high beat rate, actual earnings growth for the S&P was very bifurcated to basically a handful of stocks. And that's and like today we're seeing like Under Armour, the consumer discretionary stocks in particular have absolutely gotten shellacked as of late because they're starting to show up that a lot of these kind of more discretionary spending areas like Under Armour, I don't have to buy Under Armour or Lululemon, right? I can buy cheaper stuff. We're starting to see that really get those type of companies get impacted by a shift in consumer spending.
Okay, so a lot of things I want to dig into there. Just to make sure I heard you right, the breadth of the market is not very good again, right? We're pretty
Well,
narrow.
I don't want to say it's like super narrow. It's not super narrow, but it's not super strong either. I mean, it is, it has this rally has been pretty much an AI led rally. It's been the Palantirs, it's been the Googles, the Nvidias driving this rally for the most part. There's been other pockets of strength, but overall, it's been and again, if we kind of look at our sector market rotation, we can see that very clearly. You look at healthcare, energy, utilities, they're very out of favor. They're lagging on an absolute and relative basis to the S&P 500, and technology and utilities, which is basically GE Vernova and those type of companies, are just extremely overbought to the upside on both a relative and absolute basis. So it has been narrow from that standpoint. If you look at breadth in terms of number of stocks above their 20-day or their 50-day or 200-day moving average, that's okay. It's not fantastic, but it's not terrible. But where the concentration of the rally is coming from has been quite narrow.
Okay, so maybe not crisis levels yet, but it's not a broad-based rally that's going on in the market. There's an article I think you wrote recently, or at least it was released by RAA, about how insiders sold the July rally.
Yeah,
Um,
which is interesting.
yeah, this is sort of back to Jesse Felder. That's one of his more important indicators that he looks at. Obviously, is when the insiders they know the most about these companies, and when they start selling more, it's usually not a sign of confidence. So, anyways,
That's really not true,
yeah.
to a large degree. What that really tells you, and if you take a look at the statistics for July, there were a lot of insider selling. Insiders were selling the rally. But this also goes to the whole fallacy about buybacks being a return of capital to shareholders, because you had a record July for corporate buybacks. What that tells you is what those two numbers tell you is that insiders were selling back to the company. So this is stock option grants. This is all their executive compensation that's in the bag that they've got. And with these huge stock rallies, all those option strikes have been hit. And so they have a lot of capital on the books. And so they're basically exercising those options, those restricted stock shares, et cetera, and the company's buying them from them. So again, yeah, you had record stock insider selling because you had record corporate buying, and those two work hand in hand together.
So I get that. I mean, the insiders are the supply for the stock buybacks. So I get that. But they don't have to sell, right? They
No,
could
but
say, I'm so bullish of this company, I'm keeping this stuff, right?
yeah, but look, there's the insiders are just as smart as everybody else. And when you have a lot of gravy on the cake, you basically, or icing on the cake, I should say, or gravy on the steak, however you want to put it.
I know you're in Houston. I just
I
figured you
know.
guys put gravy on
We,
everything.
we put gravy on everything. Gravy on French fries. If you've never had that, just things.
Yeah. Isn't
But
that
yeah,
isn't that poutine? Isn't that what the Canadians do?
I don't know. But if
I'm
you
probably
put,
getting the Canadian, I'm probably getting it
there's,
wrong.
there's this little town in Texas called Granbury I went to when I was in college, and it was this little bitty hick town. It was actually just recognized recently as one of the best towns in America, but it was this little bitty cowboy town. We'd go there in the summers and we'd herd cattle and castrate them and brand them and stuff. And that's how I made my money in the summers. And there was this little place called the Dairy King, and it was a knockoff of Dairy Queen, which is the
Oh,
chain by
how
Berkshire.
funny. Yeah.
So it's the Dairy King. and you would go there and you get this big mound of French fries with white gravy and ketchup. And it was after a long day of working on a ranch, that was the best thing ever.
God, I can imagine that actually. Wow.
I
All right.
can't
Well,
eat
look,
that kind of stuff anymore. But back then I was 18, 19, 20, so you could eat anything you want.
all right. Well, one of the next times I come out and visit you in Houston, let's go to the Dairy King.
There you go. We have to drive all the way to Dallas for that.
All right. So, the past bunch of appearances, Lance, you've been saying that stocks were very richly valued, kind of gotten ahead of themselves, and that, a correction 3 to 5, 7% range
Yeah.
was doable. Did we just see it in this kind of blink and is this another sort of blink and miss it correction, or are you still concerned about the correction risk?
Well, no, we did work off some of the overbought condition. If that's all the correction we get, I'll be a little bit surprised. But yeah, I mean, it's what's been fascinating about this market is really, and this is because we trained investors now over the course of the last 5 years in particular, to basically buy the dip. And we just continue to see retail investors pile in to buy every dip, no matter what it is. They're piling into options, strategies, buying call options on stocks, leveraged ETFs. And so, yeah, every time there's a dip, we just see this kind of buying parade of retail investors step in and buy that dip. And we saw that on Monday very clearly. I'll be a little surprised that the entire correction process was just, I think it was like peak to trough was maybe, right at 3%. So you kind of got a little bit of the relative strength index worked off a bit, but you're already starting to move back up into more overbought territory. You really haven't reduced a lot of the sentiment positioning siding of it either. So I still think there's a risk here that we are going to see a little bit more volatility over the next month or so before we get into October, but there's no guarantee of that, mind you. We are certainly seeing it in particular stocks. In particular, we saw, like, for instance, Eli Lilly, um, which announced their results yesterday. Their results killed it. They had exceptionally strong results in terms of what they're doing with their drugs and their revenues and sales. Stock was down 15% yesterday because they're coming out with a GLP-1 pill. So right now, if you want to take semaglutides or take the GLP-1 for the weight loss treatment, you have to use an injectable, and a lot of people don't like needles.
Yeah.
So they've been working on a pill. Well, the pill showed that people that took the pill correctly and stayed on their diet, they lost an average about 12% of their body fat over the period of time. Well, that was within the parameters of the test and was good results for the pill, and now clears the pill for FDA approval. So that'll be available on market by early next year. Stock was down 15% because Wall Street wanted it to have a 15% weight loss versus 12. There's a big margin of error in these tests. So to drop the stock by that much yesterday was, and also considering when you look at the strength of their revenue growth and they increased their guidance, that's kind of an area of the market where there's an opportunity starting to build this up. So we're seeing some really good opportunities show up in really strong growth companies like Eli Lilly, ServiceNow, others that have had really big corrections here, because this has been, again, we kind of go back to that, kind of that confined trading. We've had people just chasing Google, Apple, Microsoft, Nvidia, Palantir. Every day those stocks are up, but there's some really, really good opportunities starting to, expose themselves in other areas of the market.
Okay. And that's why the breadth conversation is so important, right? You can look at the other places that aren't getting as much love. So let me ask you a potentially naive question, Lance. We are near the end of earnings season for Q2.
Yep.
So maybe a couple questions for you in sequence here. One, what did we learn from it in terms of how companies are doing in general? And two, because AI is such a massive driver of this market right now, um, I understand the NVIDIAs of the world are just crushing it because everybody's throwing money at them to build data centers, right? So that's the CapEx build out.
Yep.
That's not profits. I mean, it's profits for NVIDIA, but that's not like new efficiencies and incremental profits being brought to corporate America because of AI. Are we starting to see from other companies a real return on their AI spend, or is that still all academic at this point?
It's just too early to tell. I mean, a lot of companies right now, and us included, we're just in the early stages of implementing AI into our business, and that's for a lot of companies. But there's companies like, Fig, which went public this week. They had a huge IPO. This is an entire AI-driven company that provides services to people that want to connect a bunch of apps and stuff together. So, you know, you're starting to see more and more of this come to market, and so yes, it is going to create profitability. But for other companies, it's going to be a little bit longer before we see the efficiencies show up, as because it takes time to adopt AI, get it put into place, start removing workers out of the business because now AI's replaced those jobs. That's going to be something that we see over the next probably 3 to 4 years, I would imagine.
Okay. Yeah, I'm just trying to get a sense for what parallels, if any, we can drive to the dot-com bubble where the promise was delivered. It was just delivered over a much longer time frame than the market priced in, at the
Yep.
beginning of 2000. Are we getting any data yet as to whether we are overpricing, underpricing, or fairly pricing the AI opportunity yet?
Oh, I'm sure that we're overpricing some of it. But there's a massive difference between today and the dot-com bubble, and you know this as well as anybody else. These companies are hugely profitable. These are not companies that are running, at major losses, or have no real revenue stream, or actually have no business plan. They just stuck AI at the back of their name, right? Back in the dot-com bubble, it was like, hey, I'm BlueMonkey.com, and we'd run the stock up.
Right.
Um, so there is a massive difference fundamentally, between now and then. But to your question, and it's a fair question, I'm most assured that there's going to, like for instance, let's just talk about two companies, Nvidia and Palantir. Both are great companies. Palantir has got a lot of exposure to governmental contracts, those type of things. They're getting used to now analyze Social Security and other things. They've got a lot of inroads into government contracts, defense spending, et cetera. This is going to be very good for that business. But this is a company that trades, and just disclosure, we own Palantir. But this is a company that trades at very, very lofty valuation. So just if we take a look at Palantir today as an example, trades at a 223 times forward PE, and their PEG ratio
Wow.
is about 15 times price to earnings growth. Now, hold on before you say, wow, just hold on a second. And the price to sales is 128. So that's extremely expensive. However, you and I had this same conversation. I even wrote an article about this about NVIDIA about 3 years ago when NVIDIA was us in the same position. And we were like, oh, this is so expensive. I wrote
Right.
the article, said, hey, this stock cannot sustain this type of valuation. There's going to be a huge correction. There was. Stock lost about 80% of its value in 2022. Most people don't remember that because they just look at the recent chart value. But there was a huge correction in that. But at the same time, that earnings growth rate in that company has been so phenomenal that they've actually grown into their valuation over time. Now, the question becomes is, can Palantir pull off that same trick? And these are two very different companies. Palantir is dependent on contracts from other people to use their services. NVIDIA is providing hardware. And those are two different dynamics. And I'm not saying that they're not inclusive, and I'm not saying that Palantir can't meet those growth estimates. They certainly can. But I think a lot of investors, though, and I think to your question, which is, are we overpricing some of this? I think yes, to some degree, we are getting valuations ahead of Palantir is going to grow great. They're going to grow gangbusters, no doubt. But the question is can they grow into 125 times price to sales? That's a big leap. Now, again, just like Nvidia had a massive correction at some point before it took rocketing off again to the moon, Palantir will probably do the same thing. It's very realistic that at some point Palantir is going to miss earnings. That stock's going to go down 50, 60, 70%. They're going to get back on their feet, and that thing's going to take off running again. I would expect that if you're long Palantir and you're going to hold this thing, I would expect that you should expect to go through a major correction in the stock price at some point when you start to realign expectations with the reality. But that doesn't mean that over a long-term prospect of 10 or 20 years, this isn't going to be the company. I'm not saying it is either. I'm just saying this could potentially be the next Microsoft. It could be the next Amazon or the next Google. I'm not saying it is, but that's the thing you don't know is what the eventual evolution of this is going to be. So you do have to consider the valuations you pay for stocks, but you can't solely ignore stocks, particularly at this stage of the market environment, solely because of valuations, because companies like Nvidia can grow into those valuations, which it's done very well.
Yeah. So I get that. Let me ask you this, around kind of the Mag 7 type companies, the
Mhm.
Microsofts, the Googles, the
Yep.
Teslas. Um, you know, like 4 years ago, we had like $1 trillion market cap company.
Yeah.
Now we have like four or five, 3 to 4 or 5 trillion dollar companies, right? And I think, correct me if I'm wrong, I think a lot of that is AI value, right? Oh, in the age of AI, this company is going to be a lot more profitable, right?
It-
Um,
it's also the I was just having this conversation on the radio on our we're not on the radio anymore, but this was our first week of being all digital, so we're no longer on radio anymore.
Congrats,
So
by the way.
we were just having this conversation earlier this week is that, that mindless, I was talking with Mike about this on Thursday, Mike Green's theory about the mindless robot.
Yeah.
Passive investing is a big driver of those valuations.
It is, and I don't know, honestly, I don't know how much to attribute that, multiplying is due to passive inflows versus AI expectations. But I guess my question is you're right, unlike pets.com or whatever, Microsoft has earnings, has a lot of earnings.
Yeah.
But its market cap has increased dramatically because the market is expecting it to get all sorts of efficiencies from AI.
Mhm.
Um, again, and maybe the answer is just too early, but are we getting any indications yet that like, oh yeah, looks like it's really going to work out that way, or is it still hype at this point?
No, I wouldn't call it hype. I mean, there's a definite reality to
Hope,
it, right?
maybe hope
Uh,
over hype, but yeah,
yeah, okay. I mean, sure, you could say that, but again, it's only overhyped if it turns out not to be true. And see, we
right.
don't know that. And I mean,
Yeah, I don't know, and I'm not trying to
right, right.
necessarily say it is overhyped. I'm just curious if we're seeing any data yet that
Well, no,
says,
and again, I think we just go back to the fact that it's too soon. I mean, we're just building the data factories now. It's going to take time to get those data factories up and running. A lot of the evolution that's coming from the integration of AI into businesses, that's still going to take a couple of more years before probably we see any, probably in 2 years, you'll start to hear companies come out saying, hey, we've cut headcount by 25%. We've increased profitability by X% because of this integration of AI into our business. I think that just takes more time to get there because nobody's going to go chop off an arm of their business and just jump into AI. They're going to build the AI while they maintain those other employees until they're certain that they can replace those employees with AI. Right there. So there's this transition time. And so for right now, a lot of this is bringing AI on board. The same thing we're doing right now. We're bringing AI on board to streamline efficiencies like onboarding new clients, et cetera. Like for instance, we just, finally after a year and a half of working, we finally launched all the thematic portfolios on Simplevisor. And a lot of that now is AI supported in terms of the integration process of opening your account online with Pershing, selecting the account that you want, at fulfilling the trades for you, all that. That's all there for you. So, but but we haven't we're not firing any of our staff yet just because we've got inefficiency because we want to make sure that that's going to work.
Mhm.
And it may not require us to reduce our headcount, but it may slow down new headcount in the future. So in other words, one of the other benefits, we're all worried about everybody losing their jobs. One of the other situations maybe is that we may not have massive job loss to AI. We just may not hire as many people in the future, right? The job growth will slow down rather than, a big surge in unemployment.
Mhm. I'm going to take the under on that, but I don't know. So we'll see what happens. Um, I was going to ask you, your concerns about getting to a labor shedding part of the cycle here, right? Where we've had companies that have been labor hoarding forever, and when they really get the sense that, you know what, AI, it's going to do what we thought it was. We've got it in place. We've tested it. We don't need all these humans anymore.
No, I look. There's going to be a lot. No doubt, there's going to be a lot of jobs that affects. Think about a law firm, for instance. How many paralegals do you have in a law firm doing research and those type of things? And there's a new AI. There's a new company that's coming up. Just got a big round of funding by PE companies, And what they do is basically it's an AI lawyer. It's called, and it's actually called just, it's funny, it's called Harvey is the name of the software. If you were a Harvey Specter fan from Suits.
Oh, okay. I don't
Yeah.
know why I was thinking of Harvey the Big Bunny.
No, Harvey from Suits. Anyway, so Harvey's this lawyer, and it basically does the job of, researching, writing briefs, all those type of things. And so, and that's not just be just, law firms. There's going to be accounting firms, think about, and we talked about this before with AI. If you want to know if you're at risk to AI, think about the job that you're doing today. Does it require just a lot of repetitive tasks? Every day you're just filling out some form and flipping that form over and filling out the same form again for something else and flipping it over. If your job is super repetitive, you're probably at risk of losing your job to AI because AI can do that. If your job requires creativity and analysis and those type of things, trying to pick certain things out of the weeds, so to speak, trying to find new avenues, AI is probably not a threat to you. AI will benefit you in terms of helping you find those weaknesses in a business or whatever it is. AI can assist you with that, but AI is probably not going to replace you in that. So where, to add to your point, where we're going to see the job loss and the job shedding is going to be in those jobs that are super repetitive and easy to replace. And, before you say, oh, Lance, that's never going to happen, we used to have receptionists before we got an answering machine.
I'm not going to say that.
Yeah. And so what I'm saying is like some of these jobs just will cease to exist. Once we say we no longer need, and look, if you're a paralegal, I love you. I love what you do. I'm not picking on you. It was because of Harvey and the software. It's an easy example. But if Harvey does what it says it's going to do, it doesn't necessarily mean we're going to go fire all the paralegals today. It just means we don't hire anymore because now Harvey will replace all my new hires.
So there's a
Eventually,
couple.
eventually, then, as people leave, I just don't replace them anymore.
Yeah, so there's a couple big issues to that. And I don't want to really rat hole on this because this is a big topic and
Yeah.
deserves its own space. But like, um, first off, I think there's lots of jobs beyond the two categories you talked about that AI is going to be really well suited for, and diagnostics is another great one,
Yeah,
right?
absolutely.
Um, and uh, and that's kind of a higher order function, right? But AI is perfect for that. I actually think in the creativity, it's going to be it's going to make much greater inroads faster than most people imagine. And we played around with those song generating
Yeah.
apps earlier, um, but TBD. But just to your point, Lance, like even if we just cool the hiring, right?
Mhm.
So many of the jobs you get started with, right, are the repetitive,
Yeah.
simple jobs, right? It's just how you learn to show up for work and, punch a clock and be respectful and, show up on time and all that stuff. Um, the phrase I use is we're really in danger of removing the lower rungs of the career ladder, right? And I think AI is just going to, remove a lot more rungs than we've been doing to date with just plain old automation and outsourcing. And so we may have a really uh, chronic underemployment problem with our younger generations. And,
Yeah.
we're already, I don't think this is necessarily AI driven, but we are already seeing that the unemployment rate amongst recent college graduates, it's the highest it's been in a number of years at this point.
Yeah. No, absolutely. And look, I just had this conversation with my son. He's in computer engineering, and he's very worried as he graduates college whether or not there's going to be a job for him because again, I can go online and I can have Claude or ChatGPT write code for me. It's like, hey, write code to do this part, right? And then it's done in seconds. So why do I need to hire a coder, right? So, what I told him is that what's going to be critical is that you have a skill set that you can work with AI and build a
Right.
skill set of incorporating AI for companies because that's what they need right now, just like we do. And again, we're going through this massive exploration right now of all the things in our business that we can integrate AI with in terms of streamlining processes, taking better care of our customers, managing portfolios better, all those type of things. that's going to be where the jobs are, is this integration of AI into businesses. And then at some point, yeah, and this is why I think it takes a little bit longer to get there. The first phase is the integration of AI, just like we started integrating the internet, right? It's like, I'm not online. What's the first thing I've got to do? I got to build a website. Well, I don't know how to build a website. So I went and hired a guy to program a website. Do you realize we used to pay website designers like $250,000 a year to design a website?
No.
It was crazy. They were coming out of college. We were giving them BMWs, $250,000 a year salaries, and all they were doing were building websites in HTML.
Yep.
Right? Today, if you can build websites, you're making 40, 50 grand a year, and nobody really wants you because AI will do that for you. But the point is, we're going to go through that process to where we're going to pay a lot of people a lot of money to integrate AI into my business. Once that AI is integrated, operational, and functional, the next phase is going to be, okay, can I continue to operate my business more efficiently and start reducing my headcount? So again, I think it comes in stages. I don't think it comes all at one whack.
Right. And as the individual, if you're the guy that knows AI really well, you can say, look, don't cut me this round because I can still do X, Y, or Z with you using AI.
Exactly.
But still, it does sound a little dystopian. All right. Let me just get back to this last question, then we'll get off AI.
Sure.
So, where I was kind of going with this was just to try to just do a sanity check on AI-driven market valuation. So how much, if at all, Lance, are you losing sleep over the fact that we might be in an AI bubble in the market today?
Not yet. Remember, bubbles can last a long time.
Mhm.
We were in a quote unquote .com bubble for 5 years, before it finally popped. And again, you always have to remember, you can be in a bubble for a very long time. And again, this is the challenge for you as a media commentator, which is not to scare the living bejeebers out of people with bad
Yeah.
information, right? You can be in a bubble, and we can call this a bubble for a very long time, but we don't know we're in a bubble. We're just assuming that just because prices are going up, that we must be in a bubble. But earnings and revenue growth is extremely strong for these companies. Also, markets aren't going parabolics. They're growing at about a 45-degree angle, very healthy, very normal for a bullish trend. We're not moving up at a 90-degree angle like we were in 98, 99 in the NASDAQ, where we were almost going completely parabolic. So a couple of differences. Fundamentals are different. Technicals are a little bit different. But a bubble will last until eventually there is an event or a catalyst that causes an unwinding of all those expectations. So go back to the dot-com crisis or crash. The dot-com bubble was fine. It was completely okay. It was normal. Markets are doing fantastic. All the expectations were for this growth, and then Enron comes along. And there's this one analyst who questioned Enron. How dare he actually question Enron's earnings? But he questioned the earnings. And all of a sudden, the cover comes off. And everybody starts looking at the hood of Enron and sees that there's just nothing but fraud, essentially, inside of Enron. And then they're like, well, if it's here, where else is it? And then they went to WorldCom and Lucent and Global Crossing, and just one company after another turned out that it wasn't just that they were just fraudulently, reporting a lot of their data, but which they were, but they had no real activity underneath the surface. It was a lot of smoke and mirrors across multiple companies. And all of a sudden, all those earnings projections crashed. And then that's what took the wind out of the market. Same thing for the financial crisis. We weren't in a bubble in 2007, 2008, but when Lehman went into bankruptcy, or actually when Lehman was forced into bankruptcy, all of a sudden nobody would trade with each other. So that was the catalyst. That was the moment that crashed the markets, because at that point there was no transactions going on. So this bubble will last until there is some event that comes along that all of a sudden adjusts what the expectation for earnings are. And look, earnings expectations, last weekend's newsletter on the website, realinvestmentadvice.com. If you haven't read it, it's all about earnings. Earnings expectations are extremely elevated. We have the largest deviation for earnings expectations for 2026, from the long-term growth trend going back to 1900 ever on record. Now, that doesn't mean the markets are going to crash tomorrow. However, every time we've had these type of deviations historically, you have a reversion in earnings due to some event, recession, financial event, credit event, whatever it is. There will be some event that causes an unwinding of these expectations and earnings, and then markets have to revalue. And then that's where you get this unwinding of the market, whether it's a bubble or not, who knows? But that's where you're going to get a much deeper correction, 15, 20, 30%.
All right. Okay, so a couple quick things. One, I'm not saying that we are in an AI bubble. I'm asking if we are.
I know.
And I ask that because I see in the comments there's a lot of people who believe we are in one, right?
I just
And
don't want you to put a headline for this week's videos like Lance says we're in a bubble. I'm not saying
well,
that.
Lance says that we're in an AI bubble. That's what I'm doing.
Exactly. I didn't say that.
Um, all right. But yeah, no, and really, what I wanted to get a sense for is, are you, there have been times where I have seen you be nervous about valuations, even though I know you say they're not good timing indicators. Sometimes you just think, look, the market's gotten, too far ahead of itself. I don't get the sense that of the things that you're really, that are on the worry side of your ledger right now, the AI bubble is an imminent issue for you.
Yeah, it's not right now.
Yeah.
Look, okay, and so and also too, let's step back for a moment, right? Let's make sure and understand that I'm not just buying. Do I own Palantir? Do I own Nvidia? Do we own Google? Do we own Microsoft? Do we own Amazon? Yes, we do. We own those stocks in our portfolio. We also own a lot of other stocks, right? We also own Berkshire Hathaway. We own, Procter Gamble. We own really boring stuff in our portfolio as well. So those are part of our portfolio, not all of our portfolio. Now, in the new models we launched, we do have an AI model that is all AI stocks or AI related stocks. We have a crypto model, which is all crypto related stocks and crypto Bitcoin ETFs. Yeah, so we do have those models available now, which are all in that source. But, we're not managing I'm not buying this stuff and just going to sit on it and just, if the market falls apart, I'm just going to sit on it, write it down 50%. No, we're going to sell this stuff, right? We're managing risk all the time. We took profits in Palantir and GE Vernova, week before last. So, before we actually had this correction in the markets, we were already taking some profits off the table, rebalancing to target, and we offset those sells with adds to things like Berkshire Hathaway, which are low volatility. So we're managing the portfolio risk. So if the market does go through an eventual deflation of the bubble, if you want to call it, or whatever it is that we're in, we're not going to ride that thing all the way down. I mean, we're going to sell and raise cash and reduce risk because that's what we do.
Yep. Okay. All right, look, I got to move on here just to bang some of this other stuff out when my voice is still working here. So headlines this week that Putin and Trump are going to meet soon to try to talk about bringing an end to the Ukraine war. There was a headline this morning that Xi tells Putin that China's ready to back peace and negotiations with the US on Ukraine. So let's all cross our fingers here and hope that this bloody war may be coming to an end. Do you still believe, from a market standpoint, it's going to be a relatively minor event, if indeed a lasting truce is announced?
Yeah, that doesn't affect earnings. I mean, the market may rally for the day. It's like let's say that
it would affect earnings for the military companies.
Yeah, but they're a very small weight relative to the overall market. So let's just assume that over the weekend, right? The world achieves we get world peace over the weekend, right? Market's going to rally like a banshee on Monday. We'll be up 2-3% on Monday, just because everybody's excited about it. But in terms of the impact, yeah, defense companies are going to take a hit on that because they need to sell weapons to somebody. And if we're not at war with somebody all the time, they're not going to have any business to sell to. So that's going to certainly hit them. But there's such a small weight within the overall market that, it's not going to be a big driver. The companies that are the weight, again, we go back to that passive indexing issue. 38% of the market is 10 stocks. So, and that's Apple, Microsoft, Nvidia, and Tesla. So how does peace in the Middle East, which would be a wonderful thing, mind you, that would be just phenomenal if we could achieve that thing. be fantastic, but it has no bearing on the impacts for earnings for Apple or Nvidia or anybody else in the top 10,
Okay.
right?
Okay. Yeah.
So
So,
again, yeah, and near term you're going to get a huge bump, but that's not going to be the big driver for the markets for the next decade.
okay. So your point is hope for it, but don't expect it to be,
Yeah,
super transformative to
yeah.
the markets.
And so it's certainly very transformative for the world. That would be great,
Yeah.
right?
Yeah. And again, fingers crossed.
Do that. Maybe we can solve world hunger next.
Okay. I'm for it.
I'm of the
Um,
Sam Kinison model. Send U-Hauls to Africa, get them to move where the food is.
um, speaking of food, folks, if you haven't watched it yet, I did interview, just released an interview the other day with Joel Salatin, America's farmer, the face of sustainable farming in America, really in the world. Really just one of my all-time favorite people, and such an important topic about, how we can continue to revolutionize our food systems to stop, sort of strip mining our soils and growing, unhealthy foods, to basically doing the exact opposite, right? Build soil density, density and microbe density, but also just produce much more healthy, much more tasty foods. It's a fantastic discussion. Go watch that if you haven't seen it yet. All right, Lance. So there was an interesting development last night. Well, I guess earlier this week, President Trump, it's August. If you hadn't struck a trade deal with the U.S., you're getting higher tariffs slapped on you. The Swiss president, I believe, can't remember if it was the president or the prime minister, came here on a plane, tried to strike a deal. I guess didn't get one done. And last night, as a result of that, President Trump imposed tariffs on 1 kilo gold bars. And we saw some interesting price action last night. I actually haven't seen what's happened this morning here. I'm just curious, do you have any thoughts one way or the other on that? I know you were talking earlier that, hey, there's some pretty good, bullish formation setting up for gold.
Yeah.
Would this add fuel to that?
Maybe. And gold's had a nice little rally here recently off support. So that's doing well. And one of the models that we just launched on Simplevisor is all weather model, which has gold, silver, uranium,
Yep.
has a lot of commodities in it. So yeah, it's helping that portfolio this morning very well. But one of the interesting things is, remember that when Trump was talking about tariffs, we had one of the big drivers for gold was all the people importing gold to get ahead of the tariffs. And so it'll be interesting to see if we get another surge or another spike in people trying to import before that tariff actually hits. So I don't know the exact actual launch date of that tariff, if it started today or not, but it'll be interesting to see if we start to see another impact of an export of gold from Switzerland to get gold into the US before that tariff actually takes effect.
Yeah, and I don't know whether it's in place yet or not.
Yeah.
But gold's up $30 an ounce.
Which is
Okay.
interesting though, because it is up today. I was looking this morning. It's interesting, but GLD and IAU as a function are actually down today.
Really?
Yeah.
Interesting.
But
Well, anyways,
but futures of gold price is, you're right. It's up about $1.10 right now.
yeah.
So interesting.
All right. Well, we'll keep our eye on that. Let me ask you about this, Lance. So you talked, if I heard you correctly, you said, hey, look, market is looking relatively robust in terms of its momentum and its technicals. There's nothing, from what I hear you saying, that you think that, a market breakdown is there's any signs of that yet, at least, worry about that. But then you mentioned a couple of economic stats that did have your attention. Let me ask you this one that just came out today. Credit card debt declined by just over 1 billion in June, which was the second consecutive monthly drop in the series. It's very notable because that would make it the first time since the economic collapse at the peak of the COVID crash, which begs the question, will the economy now suffer a sharp slowdown with consumers clearly hunkering down and no longer charging it, to their plastic? Or, similarly, has the economy already stalled and this is just the consequence of it? So I guess first question is some might say, oh, we're putting less on our plastic. Well, that's good. That means consumers are not needing to borrow as much, and maybe they're becoming a little bit more robust. You're smirking, so I'm guessing this is more like debt saturation, where consumers just can't take out any more debt.
They're more the debt saturation level, or they're turning to buy now, pay later stuff. But we don't have any real good data on buy now, pay later in terms of how much is going on there.
Hmm.
But no, this is good. Look, we've already seen this show up in retail sales data this year, which has been very weak. Personal consumption expenditures continues to be weak, even in this boomer second quarter GDP report. Out of that 3% growth, personal consumption expenditures only made up about 0.98% of that GDP number, which was very weak historically. So no, we're definitely seeing impacts to the consumer slowing down. Again, that's the jux of this weekend's newsletter. If you take a look at the employment data, clearly slowing. Take a look at ISM services. That's on the brink of contraction. The reason services is important is they make up about 80% of the economy, and the
Right.
70% of the economy, about 30% is manufacturing. And so I do a weighted calculation of manufacturing and services, and that's sitting right at contraction mode. And it's been that way now for months, just sitting right there flirting with contraction. Now, we've been here before, but when we've been here before, you'll remember when we had the tsunami kind of hit Japan, and you had the tsunami that turned into an earthquake that turned into the release of Godzilla with a nuclear power plant. That impacted all the manufacturing imports, and that shoved that indicator down to basically zero levels. And so everybody was expecting this manufacturing recession to hit the US. And we did have a big manufacturing slowdown, but services kept the economy out of recession. And we had that during the Euro crisis. We had it during Brexit, the same thing. And we're back on that cusp again, where the economy is right there at the cusp. So either services are going to have to turn around and start to grow, pretty strongly to get the economy out of that, or we're going to slip closer towards a recession by the end of this year. In other words, what I mean by that is by the end of this year, we're going to be looking at GDP growth of sub 2%.
Sub 2%. Okay. And if we get down to sub 2%, and we talked a little bit about this last time, it doesn't necessarily mean recession, but it means you're much more vulnerable to one, right? Because it doesn't take that much of a poke to poke you into it, tip you into it, right?
Yeah, well, that's what confounded everybody. Back during 2022, 2023, everybody said it was like absolutely certain a recession was coming, but we were growing at 14% nominal GDP. So you had to go from 14% to zero, and that just wasn't going to happen. And that's why we never had a recession. And despite all these other, kind of warnings over the last few years, like, oh, we're going to have a recession, we're still trying to ratchet down that GDP growth rate back towards zero. We're finally in the territory now where a recession is becoming more likely. So sometime over the next couple of years, if something happens economically that, trips up the economy to some degree, we have an unemployment surge or something happens, you're much more likely now to have a recession than you were over the last 5 years.
Yeah. And just talking about the employment numbers, we got the latest continuing claims this week, and those are continuing to rise, right?
Yep.
So just as an FYI, they're not in crisis levels yet by any stretch, but the momentum there is now pretty clearly to the upside.
Yep, absolutely.
Yeah. Okay. Well, look, Lance, let's get to your trades. I guess before we do, is there anything that's burning brightly on your radar that I haven't asked you about yet that's worth talking about?
No, I think look, the thing I'm watching right now is really just the economic data. The earnings data was okay. We lowered the estimates so much going into Q2 earnings season that we've had a very high beat rate from earnings. We've got like 85% of companies beat earnings, but not surprising because they really have a very high bar to jump over. But what we are noticing is that companies that disappoint even the least, they're really getting hit hard versus companies that are beating and doing well, like Palantir, they're up maybe 4%, versus, again, like Under Armour today, they're down like 15, 20%. So, we're seeing, and Eli Lilly yesterday down 15%. We're seeing these companies that just miss in the slightest getting absolutely pummeled. And when they're getting sold off, everybody's running to buy Google, which is like, for instance, today, it's up 3% today. So again, it's just people are like, healthcare, forget that. I'm gonna go buy tech. And we're getting this very kind of big bifurcation in the market from a relative performance basis that's really setting the market up for a decent rotation. At some point, somebody's going to say, healthcare stocks, they print money. Financials, they print money, and they're really oversold now. There's a good opportunity there. And we'll see some money rotate, but what causes that? Who knows?
Yeah, and I'm going to go back to the AI discussion just for 1 second. Like one of the questions I wrestle with is like, I don't know how to value uh, specifically enough these future AI contributions. So your point, Lance, that everybody, kind of runs towards these big hyperscalers,
Mm-hmm.
right? And so their prices go up. And then the question is just, all right, at what point, where's the line between, yeah, this company's got a ton of opportunity ahead of it to, hey, everybody's jumped in this trade and it's just way, you know, Canada Palantir is 125 times sales. I mean, it's pretty mind-boggling, right? I
Yeah.
mean, if I didn't give you the company name and I just said, Lance, this company's trading at 120 times, 5 times sales, what are the odds you would give it of actually growing into its valuation? You know,
Well, yeah, you would say that's crazy, but
you'd
you
say,
have,
I don't know the company, but odds have got to be pretty damn low. I haven't
yeah,
heard of that happening much, right? Yeah.
exactly. No, and that's absolutely true. But again, we have so much speculative risk taking in the markets. And look, we trained investors to do this. We gave them a Robinhood app. We sent them checks and we told them to go buy stocks. And every day on TikTok, we just did this. We did on our Two Dads on Money this week. We did a whole section on where Gen Zers are now getting their financial information, and they're getting it off of TikTok. And they trust TikTok more than financial advisors because that's their platform that they want to work with. So that's where they're getting their financial information from. Well, the problem is most of that financial information is people selling some other product, right? They're trying to get clicks and views or whatever it is, so they get paid by the algorithm. So they want the more views they can get. I put out a really bearish headline or whatever it is, they get paid for that, but that's attracting the slinger crowd saying, "Oh, well, that must be legitimate information," and a lot of these people aren't even registered. So but again, what we're teaching them now is, and you go to TikTok and it's, here's some guy day trading a stock or day trading crypto or whatever it is. And that's fine. That's all great, fine and dandy. But we're just teaching investors or individuals how to gamble rather than invest. And eventually that always, without fail, turns out badly. It's just a question of when.
Yeah. All right. Well, that could be a rant, but I'm not going to get into it. All right. So trades, Lance, what trades, if any, have you guys made over the past week?
None this week. Again, last week we just took some profits and rebalanced the portfolio a bit, kind of going into this bit of slop we've had here lately. Still kind of continue to kind of work for a while longer. We're just going to continue to kind of work around the edges. And then like I said, on Monday, we launched, 9 thematic models. So those are all now up and running for the week as well. So if you go to Simplevisor, you can see all the portfolios and performance now.
Do you want to walk us through those on next week's video,
Sure.
Lance?
Yeah. Yeah.
Yeah. Yeah. Give us an update on Simplevisor and specifically, show off the new stuff.
Yeah. Yeah. Absolutely.
Okay, great. And explain how folks can use it, right? I mean, it's
Yeah.
there. Let's let folks take advantage of it.
Yeah. Absolutely.
All right. We'll wrap it up here. I'll keep this real quick because I definitely can feel my voice fading here. I do have 2 rants, one of which is just basically a preview of a rant to come. But yeah, I'm going to title this rant "Pay It Forward." So I had a great trip, short trip to Ireland. I had a great trip with my daughter. I'm really glad I went. Had an unbelievable amount of travel chaos, both going out and coming back, not the least of which was losing my phone, Lance.
Hmm.
And just to be clear too, I didn't just lose my phone. I have my phone in a case that has all my credit cards and driver's license in it.
Oh,
So
Jesus.
I lost like my entire identity, right? So fortunately on the flight home, I, knew the phone had been found and was going to be sent to me. So I was able to kind of relax coming home. And I got to say too, the people who were on the plane watching me freak out were the nicest people in the world. I had a lot of very generous help from strangers. But so I land and then I get my car and I get in my car to drive home. I've got about a 2-hour drive ahead of me. And I see, because there had been so much drama when I was rushing to the airport, I didn't fill up the tank because I figured I'll just do it when I get back because I'm in a rush, right?
Right.
So there's less than a quarter tank of gas in the car. And so I'm thinking, okay, I don't know how far I can get on this quarter tank of gas. Hopefully I can get my sister-in-law lives about 3/4 of the way home. So I'm like, hopefully I can get to her house. It's going to be like midnight when I get there, but I'll wake her up, I'll beg her for $5, to just get a gallon or two of gas to make it to the make it home from there. And I don't get anywhere close to where she lives. So the light goes on. I'm only about halfway home. I get off the highway. I'm driving around, cannot find a gas station to save my life. So I end up like literally on fumes, and I pull up to what it looks to be like a hotel. Knock on the door, it's locked. Get in my car. Somebody peeks their head out, and this woman very kindly opens the door, brings me in. Turns out it's like an assisted living facility, and this is the night crew. Um, and I basically just say, look, you don't know who I am, uh, but I don't have my wallet. I don't have my phone. I can't call my wife to help me out here. I just need a little bit of money to get home. And this was a cleaning crew. Um, they didn't have a lot of money. In fact, like folks were pulling out individual singles. Like I've got $1, I've got $2. But somebody finally came up with 20 bucks. And this woman brought it back to me and said, "Hey, look, there is a gas station about 2 miles down the road here. Hopefully, you've got enough in your tank to make it. If you don't, I'm getting off my shift in 15 minutes. I will drive that route on my way home to make sure that you're not on the side of the road." So just, she was a saint. She was a perfect good Samaritan. And fortunately, I was able to make it to that gas station. I used the 20. I fueled up. I got home, no problem. And it really, first off, Lance, two things. One, we are way too dependent on our digital devices. I mean, I was like a naked man out in the world of predators. I just like I was ripe for the picking. I was just completely useless. But also, this woman was a great example of paying it forward, right? Of hey, doing a stranger a kindness. And I've always been a big fan of that. But the reason why you do it, right, is that when you're in that position, you want somebody to have the the magna was it the magnanimousness, magnanimity, to kindly pay it forward for you when you really can't offer anything in the moment. I mean, I did end up getting home and then sending her through Zelle, $100 for the 20 she gave me, which I would have been happy. I mean, I would have happily paid even more. Um, but the point there is humanity. It did, was a nice dose of restoration of my faith in humanity, but also just, you know, paying it forward is the way to do it, because you never know when it might be you that's out there late at night, alone in the world needing that help.
Yeah, and I tell you this, this is the problem with the media in general and social media in particular, is that all you see on the media is the absolute worst in human society,
The
right?
negative stories, yeah.
Right, because there's an old saying in the media, and this works in social media too. If it bleeds, it leads, right? This is why the most watched videos on YouTube are the ones with the most dire headlines. People have a natural tendency to want to see that. So the worse the
Right,
headline, the more clicks and views that it
right.
gets.
Well, Lance Roberts says the AI bubble is going to take all your money. Yeah, no, we're
Correct,
there.
absolutely, and that
Yeah,
will get if you put that out there, you're gonna get a ton of views for it, and that's okay. But that's human nature, and to your point is that I think there's a lot more good in this world than unfortunately we get to see because of the media. And everybody has this really kind of bad attitude about, oh, this sucks or that sucks or this other thing sucks. And it's just terrible because that's what they hear in the media. But in reality, it's not really that way. And, I'm blessed to know a lot of people. And, I will tell you that, if I go to my neighbors, my friends, whoever it is, and or strangers, even where I live, you'll be surprised how many people's like, sure, absolutely, help you. What can I do for you? And they want to do that. It's just unfortunately we've just kind of indoctrinated people so much with the media is like we're scared to reach out and lend
yeah,
out that helping hand because you don't, it's like, I don't know this guy. Is he trying to scam me? This guy's showing up with a coat on saying he ran out of gas and has no phone. What kind of BS is that? Right. By the way, Adam, I hope you learned a lesson that God gave you two things in this world. He gave you a cell phone and he gave you a wallet. You keep your driver's license and your money in your wallet, not
Oh,
in
I
your
know.
phone.
I know. I just fear the day when my phone is also the key to my car. Because once
No,
it is, when I lose that, I just won't exist anymore.
that's why that's why I drive a Forerunner that has a key. It doesn't even have a push button.
Yeah.
So, but the point is that I think there's a lot more human decency and love in this world than what we think there is, because we only see it on the media. We're not out there in the world shaking hands and meeting people and doing that thing. But it's just like, you know, I I I took my wife to the doctor, and there's a lot of bad rap about healthcare. And until you go through the system, you don't know what you're talking about.
Hmm.
Because, we got a diagnosis from my wife, and scary. And I called my doctor. I had blood tests done within 12 hours. I had reports back within 12 hours, had an appointment with the doctor within 24 hours, and processes all set up immediately after that. Now, you try to do that in Canada, and you
Hmm.
tell me how bad healthcare system is.
Hmm. How is she, by the way?
She's fine. She's fine. Everything's
Good.
fine.
Good.
But, you get, we're getting older, right? As you get older, you get these kind of scary reports sometimes.
Yeah. 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 No, those are the joys of being post on this side of 50.
Yeah.
Um, yeah. Well, anyways, we'll wrap it up on this then. But yeah, and I had this wonderful time traveling through Ireland with my daughter, and just every place we went, the people that we'd meet couldn't have been nicer, right? I mean, it just despite a lot of the travel travails I had, and there are others that I won't go into, at least at this point.
Mhm.
Um, the human element was the one that really just excelled. And I think at times, to your point, Lance, our society is much more disconnected. We do hear the negative way more. But just traveling around with my daughter too, it kind of reminded me of traveling around, my teenage years, where we just
Yep.
drove places that interest us and did stuff out in the real world, right? And it was very device light, and digital light. And it reminded me of the time before cell phones, where you just got
Yep.
out in the world with real people, and you realize that, hey, people are actually like nice and supportive and fun, right? And then to come back and have this thing where, like, literally, the easiest thing for this woman to do would have been to slam the door in my face and say, dude, I don't know who you are. Good luck, right? So, anyways, I'm just
No,
continuing
that's
to.
right.
Pardon me?
I know. I think you're absolutely right. No, I remember when I
Yeah.
was traveling all over Europe, and as a youth, and I think now it's like there's no way I would let my kids do what I did. There's just no way I would allow them to, just because I would literally, I just bought a one-way ticket and showed up in a country, and then started working my way around, finding jobs, whatever I needed to do.
Yep.
And I would think back now, it's like I was really stupid probably, but I had a great experience. People took me in, they helped me, all kinds of stuff. But I can't imagine, with this again, but this is what we hear in the media about what goes on in some of these other countries. I can't imagine letting my kids go do that on their own, these days. And, maybe it's no different. Maybe we just hear more about the bad stuff. I kind of hope that's the case, because there is so much of the world to see and so many experiences to have that we need to get out and be more present.
Yeah, and I think it is, Lance. My daughter, after she left me, she went to Greece to meet up with some of her friends from back home, who were traveling there. And those girls had been traveling the weeks prior in Europe, doing woofing. You know what woofing is?
Hmm.
Yeah, where you go work on farms in a bunch of
Yeah,
different countries.
yeah,
So, I mean, they had great stories about, families that just took them in and, put them to work on the farm, and they had, great experiences, and the families would then take them into town and show them the kind of the locals tour
yeah.
of wherever they were, right? So, that stuff still happens out there. But yeah, I guess we just have to really create the space for it. And I guess that's maybe my message to folks here, which is, create the space for human connection, and be prepared to pay it forward. You see somebody who's having a tough time, if you can step in and help, it's just creating good karma in general. But you never know when it might be you that is stuck there and really relying on the kindness of strangers. And I mean, honestly, Lance, I don't know what I would have done, because it was like midnight, and it was a fairly remote place, and my car was almost out of gas. I mean, I was literally going to be walking the streets, trying to find.
And see. And now you know the value of payphones.
Yeah, exactly. 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 I also learned too that I should do this, but you always should have a cash stash in your car for
Yes.
moments like this. And I just didn't at that time. All right. So the second rant, which I'm just going to spend literally 10 seconds on, is we'll talk about this in greater depth, Lance, but we've been spending, we've had a number of rants that have touched on life advice for younger generations, Gen Zs, millennials. This one is called The Defining Decades, Why Your 20s Matter and How to Make the Most of Them Now by Meg Jay. This is a fantastic book. So if you are watching and are Gen Z or young millennial, or if you have Gen Zs and young millennials in your life, highly recommend you check out that book. I'll go into detail why, maybe the next rant we do, Lance. Meg Jay, if you want to get a quick and dirty on her, she's got one of the most popular TED Talks of all time, which is called Why Your 30s Are Not the New 20s. So highly recommend you go check that out, maybe send that to some of the 20 somethings in your lives. But a lot of the wisdom that we are kind of trying to pull out here, Lance, she's really got condensed in this book.
Yep.
All right. With that, if you think the best way to get the most out of life going forward is to continue to watch Lance Roberts on this channel week in and week out, please let him know that by hitting the like button and then clicking on the subscribe button below. And if you would like some help in navigating these markets, whether you think we're in an AI bubble or whether you think there's great values to be held out there, if you'd like a professional's help in bringing the tried and true behaviors of wealth building to your financial portfolio, highly recommend you get that help from a good professional financial advisor, one that understands and takes into account the macro issues that Lance and I have talked about here. If you've got a good one who's doing that for you, great. Don't mess with success. But if you don't, you'd like a second opinion from one, maybe even as Lance and his team there at RIA, then consider scheduling a free consultation with them by just filling out the very short form at thoughtfulmoney.com, and you'll be connected with one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. As a reminder, these consultations are free, and there's no commitment to work with these firms. It's just a free service they offer to be as helpful as possible. Lance, my friend, thanks for hanging with me through this week. I'm sorry I haven't been on my A game, but hopefully I feel better enough next week to be more of a foil for you.
That's all right. No, it's great. And yeah, we'll just pick it up next week. Hopefully something will actually happen next week worth talking about. So
Okay, well, be careful. When you say that, something usually really interesting happens that we wish weren't as interesting as it were.
you know what? I would be okay with that. I'm so bored lately. This market just doesn't do anything. So I'd be good with that.
Okay. Well, I mean, a lot of people would say near all-time highs, that's a good kind of boring. So
Yeah, that's true.
yeah. All right. Well, look, Lance, buddy, thanks again for another great week.
Thanks.
Everybody else, thanks so much for watching.